All right, Bill, if you want to get us rolling, we're good. We're a minute after the hour. Gave a little
Okay.
window.
Yeah. So everybody, thank you for joining. My name is Bill Hayward. I'm with VOYA Financial, as you can see behind me at my very clean desk. For those of you who haven't heard of VOYA, we've been doing retirement plans since the beginning of retirement plans, essentially. Locally, we've been doing the city of San Jose since 1982, to give you some idea of VOYA. If you've seen some of our marketing, you've seen the origami squirrels. I'm doing it the wrong way. The squirrels and the rabbits on our commercials. We've got about, what do we have? About 60,000 plans, 5 million plan participants. Like I said, City of San Jose, City of San Francisco, we do the Giants plan. But we also specialize in small plans and new plans like this, which is why we're here today to talk about CalSavers and how that law works, whether or not you want to participate, what are your alternatives, and just kind of get into it a little bit for the next, call it, 20, 25 minutes. We want to do a high level overview and really try and get you the tools you need to make an informed decision. Our relationship with Accuchex and VOYA goes back several years now, which is how we're all on the phone, on the Zoom together. We've got some connectivity, or VOYA does, with Accuchex and their payroll system to make your life a little bit easier. Should you decide that maybe VOYA is a better alternative than the state-run CalSavers plan. And then really, why are there two people on this Zoom, right? Why do we have two people from two different companies talking to you today? So really quick, VOYA is a record keeper. So if you've had a 401k in the past, it's probably what you think of VOYA, right? We have a website, we have a mobile app, we hold the investments, you upload payroll to us. We have customer service if you need help or forgot your password. We do all those things. For plans of this size, though, what we don't do, and Chad will go to what he does in a minute, is kind of the legal compliance piece. And that's what Chad does in Plan Design Consultants. I'll let him go into that a little bit more later. I use the analogy sometimes that, hey, we're the car, it's bright, it's shiny, it smells great when it, smells great, the whole thing. Chad's the engine. You don't necessarily see it, but without it, the car didn't go anywhere. So with that, I'm going to kind of hand it off to Chad, because in his legal compliance world, CalSavers is really in there right now, and that's at the forefront of what he's doing. So I'm going to supplement a little what he says, but I'm going to hand it off to him, and he's going to give you the real compliance update and what you need to know. So with that, Chad.
Thanks, Bill. I'll start the screen share. If you want to take any notes through here, you're more than welcome to. We can send this to you afterwards if you like. Following our 20-minute or so discussion right now, you will receive an email that essentially asks you if you want us to reach out. So if you want some help after this reviewing your options, just fill that out. If you want access to these slides, just put your name and email in there, and we'll send this out to you afterwards. As Bill mentioned, my role really is to be, he uses the engine analogy. I love it. It's really to be the architect of the retirement savings program that businesses use. And what I mean by the retirement savings programs, some businesses use no program, and that's why CalSavers is here. Some businesses use IRAs, individual retirement accounts. Some businesses use 401ks. Some use simple, some use SEP, some use profit sharing, some use defined benefits, some use cash balance plans. There is a slew of different types of retirement savings programs that businesses can offer their employees. Quite honestly, maybe one or two of them tend to fit for clients. And so as the architect, it's my responsibility to understand what your objectives are, what your business structure is, and make sure that we can accomplish that with one of these designs and let you know which one it is. Now, in full transparency, I don't do all of those things. I'm well versed in them, and it's my job, if one of those items do fit for you, to send you that direction and give you a proper contact, even though it's not something that I may be able to help with. And so unlike Bill, where he has to know a wide range of topics, I'm specifically only in this narrowed retirement plan for companies space. And as Bill mentioned, it's a big hot topic right now, because for those of us, which I think all of you are, who are sitting in California right now, you have an obligation to be having this discussion internally and deciding what you're going to do moving forward, or if you have already, implement or abide by CalSavers rules. I see some chats popping up. It can be tough for me to keep up with them. So Bill, if you can monitor the chat and let me know if anybody's tossing questions out that you think we should address right now. then just chime in and let me know and I'll dive right in.
Okay.
So I mentioned what we do, just to give you a little background why our friends at Accuchex thought it would be great for Bill and I to chime in, because there's obviously a lot of Chads and a lot of Bills in this world, especially in this retirement plan space here in California. But there's a synergy, there's a connection between our groups. And a lot of that has to do with the accountability that we take for you, the businesses, the employees that we're lucky enough to help. So my firm's a family-owned business. It's unlikely that you've heard of plan design consultants like you have of a VOYA or an Accuchex. We're 31 employees. We've been here in San Mateo, Foster City for the last 45 years now, 46 years. And again, our focus is to be an extension of our partners and their clients' teams and be a true resource for you. So that's why I'm sitting here today. What's the point of CalSavers? Let's get into the nuts and bolts. There is a serious deficiency in folks reaching retirement age having enough money to retire. We all know that. But what most don't trace it back to is the fact that that is because a lot of people don't save outside of what they believe Social Security will provide to them. And it's proven, as you look on the stat on the right there, that employees are 15 times more likely to save for a retirement plan if it's offered through the company they're working for, if it's offered through a payroll deduction feature rather than saving their own money in their bank account. So you couple that with a deficiency in retirement, people are more likely to save if it's offered through the company. And then you look at the middle statistics, 7.5 million Californians lack access to a workplace retirement plan. Those pieces collide. And they collide in a way that our government looks and says, we need to do something about it. And so what can we do about it? We can step in and set up an automatic enrollment retirement program. And so here comes Senate Bill 1234.
I'm just a bill. Yes, I'm only a bill.
And this bill passes federally initially. And it has looked like every state will have to offer a state-ran program. It is soon shut down by the Trump administration, and individual states have now begun to adopt these over the past 3 or 4 years. There is, as I believe, Texas got in on one recently. I believe we now have 13 states that are in the process of implementing or are already offering. So what is it? California steps in and says, all of you businesses, you need to offer something to your employees. If you are not already offering a retirement program, and you have more than 5 California-based employees who are at least 18 years or older, then you either have to facilitate CalSavers or start another plan, an employer-sponsored plan that will provide you exemption from what CalSavers is. You're seeing the deadlines at the bottom of the screen. If you have more than 100 employees, the deadline was extended last year, but it did hit as of September 30th, 2020. If you have 50 or more employees, it is June 30th of this year. So if you have 50 or more employees, you either have to have CalSavers facilitated or another retirement program in place by June 30th of this year. 5 or more California-based employees, it's June 30th of next year. So, and they do.
You're in big trouble, mister.
They mean business. They have come out and said for each company that is not abiding by this new legislation, you are going to be subject to a $750 per eligible employee per year fine, assessed quarterly. So they're coming out right away. I will tell you, in a personal meeting that I had with the executive director for CalSavers, she said, look, we understand the pandemic has thrown us a curveball that we were not prepared for when we started to set up CalSavers and push out these deadlines. So we're not fining yet. We are warning. We are being very serious, mister, but we are not fining yet. I would expect those fines to take place anytime here, really. And if you think about the structure of CalSavers and why it's here, there is some serious debate. And someone who knows the inside fairly well, I will squash a little bit of that and say that this is not a money ploy for our state government. I feel confident in that. Now, the way in which they structured this, it is a Roth IRA contribution. For those of you that don't know, Roth means you pay your taxes now, and that money goes into the plan, and then it grows tax-free. So when you pull it out in retirement, you will not pay taxes on any of the growth that your Roth contribution accrued through all of those years. So many businesses will chime in at that point and say, well, Chad, that's clearly a money play. They want more tax money right now. And so that's why it's a Roth IRA. That is a very fair statement. It is a very fair statement. But when you look at the cost and the structure of the plan, the California government is not making any money off you being in this program. So we should know that. It is not a cash play for our government. So what is it? How does it actually operate? It is an automatic enrollment. So any employee that you have that is age 18 or over needs to be automatically put into this plan. They will be auto-enrolled at a 5% of pay deferral into the plan, and it needs to increase by 1% every year until they hit 8%. So you have to auto put them in the plan. You have to automatically save 5% from their payroll, and you have to remember to increase their savings rate by 1% in January of every year. The max that someone can put in is $6,000. If they're over age 50, they can get $7,000 a year into this plan. Please remember, for those of you that don't operate in this world every single day like we do, Roth IRAs have an income limit to qualify for. So in California, if you have some highly paid employees, even though you were supposed to automatically enroll them into a Roth IRA, they may not legally qualify for a Roth IRA. That onus is on the employee to know whether they do or don't, and to either opt themselves out or allow you to auto enroll them. That, to me, as someone who's been running plans like this for more than a decade, is a huge compliance burden on you and on your participants, because they will not find out that they don't qualify for Roth until they're doing their taxes the next year. And at that point, fixing it can be very difficult. This, to me, is a fault in the way this program is structured. So to continue going down that path, your first $1,000 that gets contributed to the plan in this automatic enrollment setup will go into a money market fund. For those of you that don't know, it's like cash. In other words, it's not really invested in the market. You're trying to maintain the value of the money you've put in. After you go above that $100,000 or that $1,000 in savings, you now are going to be invested into a target date fund based upon your age. A target date fund will diversify the money that is in it, and it will make it less and less aggressive as you get closer and closer to retirement. That's a great thing. In fact, I like the 1,000 going into a conservative cash account at the beginning too. For folks that aren't active in their investment, this is a great tool for them. You see on the screen three different steps. If you have an employee who does nothing, then the automatic enrollment, Roth, target date pieces that I just discussed all hold true. Some employees will say, you know what, I want to be a part of this, but when I do, I want to make my own elections. I want to save 8% of my pay or 2% of my pay. In that case, the employee goes online, they make these adjustments, they elect how they want to participate in this plan. The third option is an employee can go in and opt out of participating in CalSavers. So they log in to CalSavers, they say, I'm with ABC Company, I do not want to be a part of this program. So those are the three options that employees will have if you decide to implement CalSavers. It's an important note at the bottom. The folks who are running this plan want to make it clear that CalSavers is not intended to replace a 401k or a profit sharing plan or defined benefit plan. This CalSavers is a net to catch the businesses that are not willing or are not already doing one of those other plans. And so that kind of brings us into what plans you need to be prepared or have already and prepared to claim exemption from CalSavers for. So the way the CalSavers program will work is, if you have not already, you're going to be getting something in the mail that will provide you with a PIN code. That PIN code, then you'll log into your CalSavers site. You'll enter that PIN code. It will register your business. And then you will either opt in or opt out at that point as a business. You can see the plan exemptions here on the screen. So if you're a religious organization, you're not subject to CalSavers. You can have a 401k, a 403b, a profit sharing plan, an automatic enrollment payroll deduction IRA. These are what they consider qualified plans that if you are offering these to your employees, then you can claim exemption from these CalSavers rules. You don't have to go in and implement CalSavers for your team. If you don't, and if you have not or are not already implementing one, then you have to use that PIN code and you have to register through the CalSavers site that you will be offering this to your employees. As you go through that process, what CalSavers is going to require from you is to upload what they call an employee census or an employee roster. That roster is going to have to show every California-based employee, their date of hire, their projected income, their email address, some other data that they want in this roster, so that they can help facilitate the CalSavers auto enroll side of this. They want to send these employees their PIN number so that they can get on and make changes if they want. But it's important that we think about this operationally, because this is where I spend most of my day work right now. When I look at helping a small business or closely held company either implement or maintain a 401k, the number one area that they want support with is operations. That may surprise some of you. It's not, oh, our investments are not great enough. It's not, oh, our expenses are too high. It is almost always, we have an HR person, a CFO, an owner wearing multiple hats. They're trying to run their retirement plan. They have to do all of this work. Is there a way to make it easier? Because we want to run a business, not a retirement plan. Unfortunately, in the CalSavers setup, all of that onus is going to fall onto the business and its employees. So you have to upload that roster to the CalSavers site every pay period. You have to remember to automatically enroll your employees that you've hired. You have to remember to auto escalate them at the beginning of the next year. You have to make sure that the contributions are hitting the right investment accounts. These operational tools are something that I believe CalSavers has failed us all in. That if you're going to require small businesses to offer a plan, you've got to make this plan easy to implement and operate. And so these little nuances are things that have gotten left to the side that I think are important to address as you start to look whether or not CalSavers is the right type of feature for you.
Hey, Chad, we did have one question that came in, and it's for the total number of employees for the threshold. Is it at the time they received the letter, or is there a look back period?
Really good question. It is, they look at, I think it's your DE9. Our folks at Accuchex would probably know better than I would, or you all might know better than I would, but that is essentially your state reporting for your employees and payroll taxes. They're looking at that. And right now they're averaging your prior 4 quarters. So this is important for some agricultural companies, restaurants. If you staff high in a given quarter, let's say it's Christmas season, it's holiday season, so you're staffing high as a restaurant, they're going to average your prior 4 quarters. And if you've exceeded 5 or exceeded 50 on an average, then they're going to come back and enforce that you are implementing and abiding by the CalSavers rules. So it is the numbers you're reporting on your DE9. That answer that, Bill?
Yeah, I think we're good.
Okay. Here is a big point for those of you that research CalSavers online. And this term may not mean a lot to you. It means a ton to Bill and I because it's something that's discussed quite often in the 401k world. The folks at CalSavers will tell you, you are not a fiduciary. That term fiduciary means carrying legal responsibility for this plan. I believe right now that is a true statement because we have not had any legal action taken on anybody who is running a CalSavers plan. You see the stat at the bottom that 70% of audits uncover operational errors. This is in all retirement plans, not CalSavers specifically, but uncover operational errors. Let me give you a very simple example. I'm an employee. I tell you that I want 3% taken out of my payroll, but I've been automatically enrolled at 5%. And that is not corrected for 6 months. You've withheld more money from my paycheck than I gave you access to do, that I allowed to have happen as an employee. In the 401k world, that is an obligation to the business to make sure that that is done correctly. In the CalSavers world right now, they're saying you're not a fiduciary, but you can bet the first lawsuit that comes out on a CalSavers plan that says the business didn't withhold the right amount or didn't deposit it into the right account, or they didn't put it where I had selected to invest it, so I didn't get the rate of return I wanted. You have to believe that at that point, it will set precedent that businesses are now liable for those fiduciary tasks. So it's kind of a gray area right now. There is liability, but one could argue that you may not be considered a fiduciary at this point. So here's what I and Bill are currently doing for businesses. They come to us and they say, Chad, we know we have to implement CalSavers and we're ready to do so, but I'd like to make sure that it's right for us. I want to make sure that CalSavers is indeed the program that we should get into. And so what Bill and I tend to do is go through what's called a feasibility study. We learn a little bit more about why now. Why are you deciding to set up a plan now? Is it solely because of CalSavers? Do you have maybe some employees asking? Are you looking for some tax savings? Are you getting ready to hire folks so you want a more competitive benefit in the marketplace? All of these are areas that might have you answering the why now question a bit differently. When we look at designing a retirement plan for a company, traditionally 80% of the design is based upon your objectives. The other 20% is going to be based on the employee demographics. It says it on there, that's a made up statistic because I don't track that, but I believe that's pretty darn accurate. And what I'm trying to say is the employee demographic is dictating CalSavers for you, but don't forget to look at what you actually might want to accomplish with a plan like this. I'm not going to walk you through this full chart on the screen, but if you take just a second and you look, you will see a breakdown of tax efficiency by different plan types. So if you're looking here at CalSavers, and just a simple example, I have 2 owners making $125,000 a year. We've got a staff called of 10 employees making $75,000 on average. So we've got a payroll of $750,000. And let's say we go into CalSavers and our owners are able to save $7,000 a year. But in a consultation, the folks, the executives say, well, Chad, it would really be nice if we could save maybe $10, $15, $20, $30,000 a year. Like we're in a really good spot as a company and we've continued to reinvest in our company, but now's the time for us to save some for our own retirement. So what else can we do if 7K is not enough? I'll give you a very simple example of a conversation that we have often. If you look over at this column here, which is a 401k safe harbor match column, it says in this program, our owners can defer their own money and receive a 4% match from the company. So getting this ownership group up to $31,000 each of sheltering and retirement savings. But we have to offer a 4% match to the staff. Let's not forget that. So our employees participate and we've got a cost of $30,000. And most businesses right then are saying, Chad, I'm not prepared to offer a match. We're not in a position to offer those kind of contributions. So what we do then is we help you understand that by giving this match and by our 2 owners sheltering their $30,000, we're actually saving $37,000 in tax liability from the IRS. Meaning what you're used to giving the IRS with this kind of income, you're going to get $37,200 back. Yep, we still got to give 30 of that to our employees because we're going to match them. But now we're rewarding our employees and not Uncle Sam in this scenario. And so we have a plan that allows us to save. We get a wonderful benefit for our employees. Yeah, there's some operational costs. But when we look all in, our tax savings exceeds any costs associated with this plan. So if the cash flow can allow for it, this could be a wonderful feature. And then often we have employers that say, well, we want to go a little bit bigger. What other options are there? Maximizing 401ks, looking at a combo plan with a cash balance. These kind of vehicles are advanced design, but this is a conversation that you should be having before you decide to just move into CalSavers. determine if CalSavers is indeed right for you. And we can certainly help with that. And so the components of your decision, design is the big starting point. Know what the employee perception is of these programs. I think most employees will tell you they're not all that excited about Social Security, about having to contribute their own money. The government holds on to it. It's a government ran plan and it's going to be there for us in retirement. Many perceive CalSavers as the same thing. It's being forced upon me. I have to do it. The money goes into an investment account. Our government has oversight into it. It's a bit different because you get to dictate the investments in this, but still the perception is this is a government ran plan, and they're contributing it to a similarity to, I should say, of Social Security. Know that when you're in a simple IRA or in a 401k, you have access to wonderful resources. You have folks like Bill and his team at VOYA, potentially folks like me at Plan Design, to help you run this plan in a way that doesn't create a headache or an over obligation for you. You have greater investment flexibility in these other plans, and the ability to set up things like loans or hardships for employees that are going to be forced to save. It's nice to be able to access that money if you need it. If you need to buy your first home, if your parents need help with medical bills, you can access your money inside a 401k. You can't in CalSavers or in a simple IRA. So there are some benefits to be considered when you debate whether or not CalSavers is right for you. So that's going to conclude kind of the package conversation. Bill, I see some Q&A and some chat. I'm going to stop the screen share. Hopefully that was insightful for each of you. Our goal was to give you a surface level review. It's not quite surface level. We gave you a little bit more to chew on than that. But hopefully it gives you some thought around what your obligations are, what your timeline is, and what we would be recommending if you were talking with us, which is don't just commit, review and make sure CalSavers is indeed right for you.
So Chad, with that, I've got a statement. One point I want to make, and then I have some questions that came in. As Chad sort of discussed here, this is a state-run plan. If you go with it, it could be right for you, right? It could be right. We're not saying it's wrong. It could be right for you. But the onus is really on you as an employer to do this. It's a state-run plan with federal oversight, with ERISA, which is the law that governs retirement plans, right? So there's things that you have to do. So you don't have the team like we're talking about here, but it still could be right. Now, one of the things is why the three of us put this together. Accuchex system talks to VOYA's system. They can send us your data, right? And then Chad and his plan design team can access that data. So we're all connected, right? So we kind of give you that layer of administrative support. An example of this, and Jim Ruland from Accuchex and I've talked about it. CalSavers needs 5 pieces of information sent over. If those pieces are, let's say there's something wrong in one of those pieces and you've got 25 employees and somebody's social's off by one number, or excuse me, somebody's address is off by a number, zip code's off, they reject the file. You've got to figure it out. These are the kind of things just day to day and like that we can help you with. And Chad said, look, you're running a business, you're not running a 401k. Let someone else do it. Let the three of us handle that. So that's one thing I want to point out. And then from a standpoint of questions. So here's Chad, we got 3 questions here. Is this a requirement for not-for-profit organizations? That's question 1.
Yes, it is, unless you are classified as a religious organization. If you are just a 501c3 or traditional nonprofit, then yes, you are subject to CalSavers. Okay.
I have another question. Clarification. Did you say that you need to upload a roster every pay period? For those
that is correct. As you can imagine, the automatic enrollment can happen in any given pay period, depending on when the employee was hired. So that roster needs to be uploaded so that you know who will be automatically enrolled.
Okay. And then this is a different question from somebody different, but it's an offshoot. We have someone here who's a staffing company. They have many people, they pay each week. Someone may work only 1 week. Is there a minimum time frame they need to work? So basically, eligibility for automatic enrollment, I think, is the question.
No, there is not. The automatic enrollment, the employees will receive the notice within 30 days. So theoretically, if they're not still with you 30 days later, they're not going to be auto-enrolled. They have no payroll to auto-enroll from. But there is no minimum amount of work. So if someone's working 2 hours a week, then they're going to be part of the CalSavers roster that you're uploading.
Okay. That's really it for our questions, I think. So we're going to send out a follow-up, and obviously we went through this in 30 minutes because we know everyone's busy. We're going to send out a follow-up. If you have individual questions that you'd like to talk to us one-on-one, we're going to run you through both scenarios, right? Is CalSavers right for you? Is it not? What are your alternatives? What are the costs? What are the investments? What's the infrastructure? We'll do all that stuff. So we'll look for our follow-up, and thank you for your time.
And thanks, Bill. I'll say for those of you that want to stick around, there's a few in the Q&A. So Sydney, Angelica, Diana, I can answer those questions real quick if you stick around for just a moment. So thank you. Thank you all very much for those of you that are tuning out right now. I appreciate you tuning in. Take care, everybody. Sydney, you will receive a PIN code, and you do have to log into CalSavers and claim exemption because you are offering a 401k plan. So when you get that, make sure you log into CalSavers and elect that you are already offering a qualified plan. I will tell you in fear for you, I was chatting with someone who just opted their daughter out, who she's working in the restaurant space. She's 18. She's home from college. She was about to be auto-enrolled. He said it was like the DMV of retirement plans, because it took him, and this is someone in our space, it took him 1 hour and 15 minutes to properly claim exemption for her. So it could be a little tedious. I know your friends at Accuchex have some experience. You saw Jim making some comments in the chat. Leverage your team, leverage your folks. But yeah, you will have to opt out. Angelica, that is a dynamite question, and it is still slightly up for debate. If your 5 locations are part of what's called a controlled group, meaning all 5 of your restaurants are covered by the same ownership, is usually the most common way that businesses are considered a controlled group, then you would set up one plan to cover all 5 locations. If you are, and you mentioned we're each using our own EIN, then yes, CalSavers is likely going to have you either set up one plan and opt out the other 4, make note that you're offering CalSavers to everybody through the other EIN, or you can set up 5 different EINs if you have different reporting for each location, which is something you can work with your team at Accuchex on. Is if we're using divisional reporting and we have separate census files for each location and payroll feeds, then you're probably going to want to do 5 different ones so that you can silo the employees individually.
Chad, could you maybe do high level on how we determine common ownership?
Yeah, it's a tricky one. It's kind of a 3-part test is the easiest way I can set this up. A business that has 80% or more common ownership. So let's say you have a husband and wife that own 60%, a son that owns 20% or 21%, and then outside investors that own the remaining 19. So that's 81% between the family over here, and they own 100% of the other location. Well, the common ownership between the two is 81%, right? Common owners at each location total 81% of aggregate ownership. So that would be considered a control group, which means whatever you do for one location, you would have to do for the other. The 3-part test, and I won't get into it, also looks at if you have affiliated services amongst those businesses, even if there's not a lot of ownership. And then finally, a management service organization, which is if you're putting all your managers and executives at one location and they're running oversight over the other 5 locations. In this example, you would, whatever you do for that management group, you got to do for the other 5 locations. Diana, fantastic question. Diana says, we have dual rates of income. Some are variable hours, some might be salary, some might be receiving overtime. What they will want to see is what the net income is, or sorry, gross income for that employee that pay period. So regardless of the different variable types of income, rates or hourly, it's going to be based upon what it is in total for that pay period. I think that is it. Yeah.
A couple questions on the chat line, but one that just came in, I answered it there, but is there a specific time we should start a 401k if we want to? I think the answer pretty much is anytime. It's not
anytime. I mean,
yeah.
I would tell you, number one would be consider your CalSavers deadlines. The second would be, it depends a little bit on your objectives. There's no good or bad time per se to start one. But if you're looking for tax efficiency and you're looking at something like a match, like I mentioned in the illustration, most businesses would say, well, if this is about tax efficiency, and we want to keep our match costs down for the first year, it's great to start a plan in June, July, August, because now our employees, including ourselves, only have, half or a quarter of the year left to save. So our match costs are lower in the first year because we only have the plan in place for a half or quarter of the year. So that would be the only thing that I would mention in terms of timing. If cost is an issue and you're prepared to offer a match, that's why we're so busy right now, is it's mid-year, folks are implementing. And it takes about 30 days, 60 days to implement a plan. So you're going to want to give yourself enough leeway to leave time in the year to contribute.
Chad, we have one more question, and it's a pretty good one. Well, they're all been good ones, but if businesses have separate EINs, can I offer CalSavers to one and something else to the other?
Ooh.
It's a good one.
I'm going to go back, and I don't directly know the answer, but I know the law well enough to say equal rights, benefits, and features says that whatever you're doing for one business, it has to be sufficiently generous for the other business. Now, those are big words, but that's what the IRS gives us. So if you have a CalSavers plan that doesn't have a match or any employer contribution, and then you have a 401k plan for the other business, and you're giving them a match or an employer contribution, that would be considered discriminatory because the businesses are related and you're being sufficiently generous, giving a match over here, but nothing over here. So while I directly don't know an answer to that, my thought would be no, because you would not pass equal rights, benefits, and features.
Well, and maybe the last thing, I think that's the last question, but I'll make a comment there as well. ERISA, the law that governs all this stuff, it's designed to protect the worker, not really the business owner per se. So they have everything equitable, right? So under that 30,000 foot idea, that's why the law is created. Chad, I think, is correct in all of this, that you offer a match to your employer money to your top end people, and you don't give it to your rank and file, you're going to get dinged by the DOL.
Absolutely. And it is the DOL that puts a hand in that, and they're coming in saying, we want you to be fair. Yeah, it's wonderful that you're rewarding these people with a match, but it's unfair to these people over here that aren't getting it. So yeah, that's where it comes from.
Okay, we got one more that just came in. Will all simple plans qualify? And if we already have all employees enrolled, do they need to opt out of CalSavers?
Say that again, Bill. I didn't see that one.
Just came in. Will a simple plan qualify? And if we already have all employees enrolled, do they need to opt out of CalSavers?
Good question. A simple plan does qualify. It allows you to claim exemption. Your employees won't need to do anything, but you as a business will need to take your PIN, log into CalSavers, and claim exemption because you're offering a simple IRA.
And then one more, somebody put a comment on the chat. I'm not going to review the comment, but it was really around how long it takes to start a plan. So if you were starting a brand new plan, never had one, all that stuff, it's 4 to 5 weeks, generally speaking, soup to nuts, before you can start putting money into it through VOYA. CalSavers, I don't exactly know actually how long it takes, but
Jay Turner just threw a good one, and this one just came up this week for us. He says, if it takes 30 to 60 days to set up a 401k plan, can we opt out of CalSavers, knowing that we won't have the plan set up when the June 30th timeline hits? So we actually called the CalSavers powers to be. Slightly different scenario. The client that we have can't implement a 401k because of what's called successor rules yet. And in their scenario, CalSavers said, yes, because it's going to overlap the next quarter, you should set up a plan to avoid the fine. Now, the client came back to us and said, holy cow, the fine, $750 per eligible per year, assessed quarterly. Let's say it's going to cost us, $1,200. It's going to be more of a headache for us to set up auto enroll, set up CalSavers, run the CalSavers plan, change it to 401k when we can. So if they fine us, we'll address the fine then, but we're not going to try to implement both. This client knew a 401k was right for them. And so they are going to risk it. Their 401k plan will be set up in December of this year. That's legally the earliest that they can set theirs up. But so to answer your question is, CalSavers is saying when your deadline hits, you have to have something in place. I strongly believe that if anybody were to come to you and say, well, you didn't have a 401k plan in place on June 30th, and you said, look, in good faith, we were already in the process of implementing, we just didn't realize it was going to take 30 to 60 days. I can't imagine them assessing you a fine in that scenario.
Yeah, I agree with that. One other one from Rob here. If I'm already set up on CalSavers, can I still set up basically a retirement, custom retirement plan and opt out of CalSavers?
Yes, you can, Rob.
Yes, you can. Yeah. Yep.
So you would just, once you get your 401k set up, you would just notify them that you are done with CalSavers, stop the process and the auto enroll and all the features there. And you would now be running the 401k plan and you claim exemption.
And also to the extent, if you put money into a CalSavers plan and you realize it's too onerous, there's not enough back office, you can then move it out of CalSavers into another financial institution.
Jim just made a really good point too. If you are registering for CalSavers, when they ask for your payroll provider, make sure you put Accuchex in there. That's a huge benefit because most payroll firms are not doing that at this point, to my knowledge, at least. So it's a huge benefit that you have an opportunity to put Accuchex in there and they can leverage their skill set and their technology to help you all.
I think that's it. I think we've run out of, I think we're out of questions. It's been a lot of good questions.
Yeah, they were a lot of situational questions, which are fun ones to think through. So thank you all very much. Appreciate the time, Jim and our friends at Accuchex. Thank you so much for allowing us the time to help your folks. Hopefully everybody's got marching orders now and understands what is required of them and can work to figure out what is going to be in your best interest. Thanks, Bill.
All right. Thank you, everybody.
Take care, everybody. Bye-bye.